Welcome to the Fearless Farm Finances online course provided by the Midwest Organic and Sustainable Education Service, or MOSES. My name is Brad Sirianni. I'm a farm business and production management instructor at Western Technical College, and I will be covering Module 8 on ratios. The objectives of this lesson are to discuss what are ratios good for and discuss the top 7 ratios as mentioned in the Fearless Farm Finances book, and provide you some tools and resources and help you determine how ratios can work together to tell the story of your farm. So what is a ratio? Well, as defined, it's one number divided by another to express a relationship, and this relationship is in a quantity, amount, or size between two or more things. So examples in production agriculture would be tons or bushels per acre, pigs per litter, milk per cow, pounds per acre, pounds per square foot, etc., all those different things. So from a financial standpoint, our ratios would be like our current ratio, our debt to asset, our equity to asset, and debt to equity ratios. So why do we use ratios? Well, we use it to compare information. We collect a lot of data, and it is difficult to do that, to compare information. So sometimes our ratios can simplify things and help us to analyze the data and look at it a little differently, and to track trends, for tracking and for trends, whether it's tracking during the year or trends over periods of time. And it also gives us goals to achieve. For example, our current ratio, we'd like to be at 2 to 1 or better. And wow, that's a great goal. Many times we have to have certain ratios in within certain parameters to qualify for financing. And you'll have to work with your lenders to know that, or work with your consultants to make sure that you're in line and or can correct things so that you can qualify for financing. Many times these ratios can be more useful than just the straight numbers, and by putting many numbers together, it is much easier for you to interpret the data if it's in a ratio. Obviously, you need to do a little bit of education. That's why we're doing this today, so we understand what's driving those ratios. And ratios many times support each other, and sometimes one can show us a certain situation, and another one will show us another piece to that puzzle. So it's important to know how they work and work together, and they also can help us verify problems. So where do these ratios come from? So it's really important to understand just exactly where we're pulling these numbers from. So I'm going to do the best I can to help you with that. But there's usually 3 areas. One of them is the balance sheet, and it's just so critical to have an accurate balance sheet all the time so that we have accurate numbers. And we're going to talk about something later on about accrually adjusting, making accrual adjustments, and having really accurate balance sheets, and especially in terms of accounts receivable and accounts payable at the beginning and ending of year, really helps us accrually adjust things. We get them from our income statements, and we also get them from our statement of cash flows. So here's an example of a balance sheet. Again, just as a reminder, we have our current assets and current liabilities on the top portion, our intermediate assets and intermediate liabilities in the middle portion, and our long-term assets and long-term liabilities towards the end, and then with our totals at the bottom, and sometimes our balance sheets include our personal assets too. All with getting to that driving ending number of what's our net worth or our equity in our business. This is an example of a balance sheet, a spreadsheet balance sheet that is noted in the Fearless Farm Finances book. This is the Auto B Organic one. Has the same information as the one I just previously showed you, just put together a little differently, but it has the same info. This is an example of an income statement. So our income statement shows where our income or revenue comes from, and then it shows our expenses. And some of these can be in more detail or less detail, but our income and our expenses, and then in the bottom it shows our inventory changes and how we then start to accrually adjust things. And it also will show us our depreciation, and all driving towards that bottom number of determining what our net farm income is. Up above, our income minus expenses is our net cash income. And then when we adjust things, we get to our net farm income. So the Auto B income statement looks here. Again, it's in a spreadsheet format. Same information, gets you to the same numbers. Some just show you in more detail than others. Our statement of cash flow combines a bunch of different things, and many times these statements are wanted by your lenders at the end of the year, or your accountants put these together, or you can put them together, and we can interpret them or use them to calculate other numbers. So to help you a little bit more with what exactly ratios come from these different resources, our balance sheet ratios we divide into liquidity and solvency ratios, and under liquidity we have our current, our working capital, and ratios, and our solvency ratios are debt to asset, equity to asset, and debt to equity. From our income statement, these tend to be our profitability ratios. We have our rate of return on assets, our rate of return on equity, our operating profit margin, and we can also look at earnings before interest, taxes, depreciation, and amortization. From our statement of cash flows, we can determine our capital debt repayment capacity, our capital debt repayment margin, our capital replacement margin, our term debt coverage ratio, and our replacement margin coverage ratio. Our efficiency ratios are generated from all three financial statements, and these would be our asset turnover, our operating expense, depreciation expense, interest expense, and net farm income ratios. The ratios shown on this page in bold are the ones that we will focus on for this presentation and are also focused on in the book along with all the others, but these are what the book refers to as their top 7. So before I go on, many of the slides I'll show you when I'm covering the ratios will show you the parameters and help you figure out what's good and what's bad. And so just remember, this is the Farm Finance Scorecard. It was put together by the University of Vermont Extension and the Center for Farm Financial Management at the University of Minnesota. Red means you're vulnerable, yellow means you're okay, and green means you're strong. And I will always challenge you to have this. And especially at the end of the year, you pull this out and you see where you're at. And or during the year, if you're updating your balance sheet, you can pull it out and track your trends. But anyways, that's the Farm Finance Scorecard. So let's talk about liquidity quick. So liquidity, remember, is the ability of your farm business to meet the financial obligations as they come due. We want to be able to generate enough cash to pay our family living expenses and taxes and make debt payments on time. And so on our balance sheet, looking at liquidity, this will tell us that. So our liquidity ratio is the current ratio. And our current ratio is calculated by taking our total current farm assets and divided by our total current farm liabilities. And this measures the extent to which your current farm assets, if sold tomorrow, would pay off our current farm liabilities. So do I have enough current assets to cover current liabilities? And keep in mind, current liabilities include your current portion of your term debts. And so what that refers to or means is that the principal payment that you're going to be making on your loans is a current debt, meaning it's due within the year. And so that's why that part of it would be included in our current liabilities. So keep in mind that sometimes the value of our current assets can change. We may value them today at this much. Tomorrow they could be sold at XYZ amount, a different amount. So it is really important that we do a good job of valuing our current assets so that when we sell them for at least that amount listed or better. And that means our balance sheet will be consistent and strong throughout. Sometimes it doesn't work that way, but just keep that in mind. We don't want to overinflate the value and misrepresent things on our balance sheet. So the desired level of these can vary by type of farm. And so a dairy farm versus a cash crop farm, we just have different cycles of production. So our current asset, for example, would be our feed inventory on a dairy farm. Well, come spring, our feed inventories are starting to run low. And then as we start to harvest things, our feed inventory will come back up. The same thing with the fruit or the cash crop. We can value the crop out in the field, but when we harvest it, now we can really have a better value, because we're not supposed to value our crop growing out in the field for what it is if we had already harvested it. We can only really value it for what we have put into it. And that's a whole nother discussion. But just remember that it can vary depending on the day that we collect this data for our balance sheet. So just remember that our current ratio, 2.0 is the goal. And according to this, if you're at 1.7 or greater, it's strong. And if you're lower than 1.1, you're vulnerable. So just think about it. If our assets equal our liabilities, we're vulnerable. We have nothing left, because current assets minus current liabilities is working capital. And we like to have something left over, and we like to have working capital. So from our balance sheet and the Auto B balance sheet, our total current assets there were $111,450. Our total current liabilities were $48,837. So you divide those, and we have a ratio of greater than 2. So according to this, they're in a very strong current ratio. So let's move on to solvency. And as a reminder, solvency is the ability of a company to meet its long-term financial obligations, and it demonstrates a company's ability to continue operations into the foreseeable future. And so kind of what we're saying is, if we cashed out today, would there be a lot left over? And if there is, that's a sign that we're solvent and that we can survive. So under solvency is our debt to asset ratio, and this is taking our total farm liabilities divided by our total farm assets. So essentially, we're asking, or what we're saying is, what percent of my business assets do I owe to creditors? So you could probably imagine this is one that the bank is going to keep a close tab on, and you should too. So it compares the total farm debt to the total farm assets, and a higher ratio is an indicator of greater financial risk and lower borrowing capacity, because you own less of the business. So it measures the financial position or solvency of the business. So if you think about this, at 0.5 you own half and the lenders own the other half. At 0.7 and higher, wow, that's a big danger, because now you only own 30% and the bank owns, or someone else owns, 70%. And this usually reflects that, hey, you can't generate, or it's very difficult to generate enough money to be able to pay off everything. And sometimes looking at your debt to asset ratio also can reflect your balance sheet structure. And so it's probably important to keep in mind that we do like to look at the structure of your balance sheet. Is it evenly distributed between current, intermediate, and long term? And sometimes there's varying reasons for it to not be balanced. So for example, it's really nice to just own money on some long-term debt or land, and you have no debt anywhere else in your balance sheet. That's not always very realistic, but it could be nice. Eventually, we just don't want to have any debt. We want to have a lot of working capital, or we want to have a lot of long-term assets, or in terms of retirement types of assets. So here we're looking at our total assets and our total liabilities from the Auto B Organics balance sheet. So when we come up with these ratios and we see these colors are red, yellow, and green, many times we'll ask ourselves, well, what do we do to make that better? Well, this is a great resource to help you figure those things out. So, for example, if you do have a debt to asset ratio which is 60% or higher, we know, or you can deduce that, hey, we have to increase profitability somehow, or we have to minimize our family living, or we have to forego the purchase of things because we can't afford to have any more debt, and we probably need to sell unneeded assets and use the funds to reduce our debt. So whenever you see these throughout the presentation, that's a resource for you to be able to look at them and study them and figure out, wow, hey, this is what I need to do to either maintain or improve these ratios. So let's jump to operating profit margin. This is a profitability ratio coming from the income statement. So this shows the operating efficiency of the business, and if expenses are low relative to the value of farm production, the business will have a healthy operating profit margin. A low profit margin can be caused by low product prices, high operating expenses, or inefficient production. So, the formula to determine operating profit margin is OPM, or operating profit margin, equals the net farm income from farm operations plus the farm interest paid minus any value of unpaid labor and management divided by the gross farm revenue, accrually adjusted. Remember, that accrual adjustment is just attempting to look at what actually went into the production from that year. So it would count prepaid things going from the previous year going into this year, but it's not going to count any expenses that you may have prepaid this year that should go for next year. And also inventory adjustments. So in this case, Auto's operating profit margin, if you refer to the book and you look at the numbers, here were the numbers that they use to determine that, hey, they had a 12.4% operating profit margin. So if we look down at the bottom and we look at where this would rank, this is rather low. It says 15% is vulnerable and 15 to 25% is okay, and above 25% is strong. The one thing I will tell you here is that operating profit margin really varies based on your type of business. I think a lot of dairy and livestock types of farms, they struggle to get above 15%. A vegetable farm, on the other hand, would probably be very unhappy if they were not at 25% or greater. So we kind of have to keep in mind that our different types of businesses or enterprises will probably have different types of operating profit margins. But this is kind of the standard of where we should be. So again, here, if we do have problems with our operating profit margin, we may have to look at different enterprises. Just look at what we're going to have to do. In essentially operating profit margin, we got to maximize profits and minimize expenses. And so we'll have to dig deeper into those things and figure out how we can do it. So let's jump to our term debt coverage ratio. This tells whether your business produced enough income to cover all your intermediate and long-term debt payments. This one is looked at by banks a lot, and it is a very good indicator that if you can produce enough revenue to be able to make these debt payments. So a ratio of less than 1 indicates that the business had to liquidate inventories, run up open accounts, borrow money, or sell assets to make scheduled payments. So just kind of keep in mind that the magic number is 1.2. If we're at 1.2 or greater, we have a good term debt coverage ratio. If we fall below that, we're very vulnerable and probably in trouble. So again, if we look at this resource as a way to help us, essentially if we have a term debt coverage ratio of less than 1.2, we need to look at restructuring or reamortizing loans, selling unneeded assets, and foregoing new debt obligations and maximizing profits. So our asset turnover rate. So our asset turnover rate measures the efficiency in using capital. So think, we're going to make capital purchases. We're purchasing assets that are going to be used in our business. Are these assets going to bring value to our business? Are we going to be able to turn them over, use them, and generate profit? So you could think of it as capital productivity. Generating a high level of production with a low level of assets will give a high asset turnover rate. So if the turnover is low, you'll want to explore methods to use the capital invested much more efficiently or sell low return investments. So many times on balance sheets we'll see land that's not used very well, or a lot of machinery and equipment that's on the balance sheet but it's not used efficiently. That will tend to drive our asset turnover rate down. But if we just get rid of all those things that we don't need, then our asset turnover rate will be much better. Well, assuming that we continue to generate the required revenue. So our I forgot to mention on the asset turnover rate, if we're below 30%, we're vulnerable, and if we're between 30 and 45%, we're okay, and if we're at 45% or greater, we're doing well. So asset turnover rate, very important thing to track and keep and measure on an annual basis. Our operating expense ratio. So think about it. Our operating expense. So the amount of our expenses in relationship to the revenue that we generate. So this shows the proportion of farm income that is used to pay operating expenses, not including principal or interest. So are you paying too much for your operations? This is what's going to help you determine that. So what kind of sales do you need to cover your expenses? So our operating expense ratio is determined by taking our total farm operating expenses minus depreciation and interest divided by our gross farm revenue. And so here, if we have a ratio of less than 60%, we're doing well. So remember, we're looking at our amount of our expenses. So we don't want our expenses to be high in relationship to our gross revenue. So we want our percentage to be lower. So if we're in this 60 to 80%, we're okay. And if we're above 80%, obviously we're very vulnerable. So let's jump now to our net farm income ratio. So our net farm income ratio is net farm income divided by gross farm revenue. So this compares profit to gross income. So it shows how much is left after all farm expenses except for unpaid labor and management are paid. So it's looking at something similar to our operating expense ratio, but just a little bit differently. It's coming at it from a different angle. So these two many times are important to look at the same time. So in terms of a measurement, if we're 20% or greater, we're doing well. If we're 10 to 20%, we're okay. And if we're less than 10%, we're very vulnerable. So on this side, if we look at our asset turnover rate and our operating expense ratios and net farm income ratio, we can look at, wow, if we're vulnerable, we need to look at maximizing operational efficiency. We need to really scrutinize costs, we need to increase revenue, and we need to manage these assets. We need to sell unneeded assets, reduce debt, or restructure and or reduce our interest expenses. Bottom line, we got to maximize our profits somewhere. So that may mean we have to generate additional income somehow. So anyways, you can peruse through the rest of that and look at the rest of that resource. But so now we just covered 7 ratios. We went rather quick, but I hope that you got a good feeling of what the ratios are, where they come from, and how they can help you evaluate your business. So in summary, ratios provide a means to evaluate your business and tell your story in simplified numbers. We covered 7 ratios: the current, the debt to asset, and the operating profit margin, the term debt coverage, the asset turnover, and the operating expense, and the net farm income ratios. There are also some tools and resources, and I'll actually get to that in just a moment here. I provided some of them for you already, and I'm going to mention a couple others. Some action steps for you to do. Create your balance sheet and make sure that it's accurate. Evaluate and analyze it and look at, wow, what's my current ratio? That's a really easy and simple one to get from your balance sheet. And then obviously your debt to asset ratio. Share it with others, get their input, and then form a plan and keep it simple. Take baby steps and put together these other financial statements and start to generate these other ratios. And look at your expenses versus your revenue, and your net farm income ratio too. And then build upon it each year. Work on getting better. Track it. So something to ponder. Judgments are based on balance sheets. So just always think about, what is a good balance sheet? It really is a valuable tool, and I just think too much we take it for granted, and we just cannot do that to operate a good business. And so then also think about, what is a good financial situation? So I want to thank you for your time and commitment to improving your farm financial knowledge. I know we went through this quickly. There's no way we can do justice to it and provide a presentation to you in a short enough time to keep you captivated. And now I'm just thank you again to Fearless Farm Finance's contributors and writers, and to Moses for helping bring that resource to us. And just one last thing, these are the resources, of many of which I have used to help put together the presentations. The Farm Finance Scorecard is right here. Of course, you can Google that, and you can find that at a number of different places. This is one of the places you can find it at. And if you want to dive deeper into these ratios, and actually many of the measures that the Fearless Farm Finance's online course covered, I would go to Interpreting Financial Statements and Measures at the Center for Farm Financial Management at the University of Minnesota, and they have a video series put together of all these things, everything from balance sheet to the financial statements and all the ratios and everything in between. It does a really good job. I'm not going to lie to you, it's long, but it does a very good job, and it's probably one of the best resources you can find in the country to help you understand these things. So with that, I thank you again for your time, and I wish you the best in all of your endeavors.